This is our income statement. The beginning part is where we put all the external things that we could point to. As you can see, we predict that the units or rooms that we'll have for people to live in will be 8 in years 1 through 2, and then we'll make an addition in year 3 and another addition in year 6. The death rate is a random number that Excel changes for us, and that's tied into our occupancy rate. So we have their units available minus the death rate. So then we have the price per unit for a tenant, and we are saying that it increases by 6% per year. This is our forecasted number of sick days per tenant, and this is tied into the days of medical care that we need. So there's the number of tenants or forecasted occupancy times the sick days per tenant, and that gives us our days of medical care needed. And then we have our average cost of each medical visit, how much these total cost of medical visits will be by the days of medical care times the average cost of the medical care visit. And we did that because we're saying that we'd make a commission from referring doctors to our tenants. So we get a percentage of that. And that was 10% of that. The average assets left after death are furniture and whatnot that they leave that will sell in a garage sale. Our number of employees are 4 in year 1 through 5, as stated on the internet, and then it increases by 1 in year 6. And we have the manager's wage, which was the average hourly wage in Texas times the number of hours per week times the number of hours number of weeks in a year. And the other operating revenues from the assets left after death. The labor costs, we said that we'd pay each employee around $20,000 per year. Our general and administrative is the manager wage plus a $100 flat rate. Our meal costs, we looked on the internet and found that to run a care home is around $80,000 per year. Our building maintenance, we said to be about $1,000 per year, increasing by 2% per year. Our utilities were taken as the number of forecasted tenants that would be living there times the average kilowatt use per tenant times the cost per kilowatt hour times the plus the fixed utility price of $100 per year. And that gave us our total. And then we have our operating profit. Our depreciation expense is tied into our building, and that had a 30-year life. And then our mortgage loan interest expense is our mortgage, and it has a 5% interest expense. Our extra bank loan interest expense has a 5% interest rate. Then we get our taxable income and our income tax expense at a 35% tax rate, using an if statement to make sure that if it's negative, it's a 0, and then we get our net income. After that, we have our minimum cash inventory of $500, we decided. Our cash above minimum. Our accounts receivable are tied into our sales revenue therapy, because we said that we wouldn't get paid on those commissions right away. And so we said that they had a 60-day receivable. Our inventory is tied into our meal cost, and we said that those had a 10-day account accounts receivable. Then we have land of $30,000, and we found on the internet, and that's done by finding the number of acres that the building is on times the cost per acre of $2,000, and then the accumulated depreciation, and that gives us our total assets. Next, we have our accounts payable, and we said that our accounts payable were tied into paying for our meal cost and paying for our building maintenance, and that they had a 30-day payable. And then our income taxes payable, our mortgage loan, which was our building plus our land times the 5% to figure out how much of a mortgage loan they would give us. Our extra bank loan was computed by the DFN. We said that we would issue $300,000 of common stock. Our retained earnings is computed here. And then we have our total liabilities and equity.